Okay, folks. So my usual reminders, your final project is due a week from today at 5 p.m. on Monday, right? And you got the to-do list, so you know exactly what you need to do. If you can, as you get the numbers nailed down, and don't get freaked out because, oh my God, the people already have the numbers. Most people don't, but during the course of this week, it will happen. Trust me, it will happen. The numbers will start coming together, and it's got to come before you start writing your report, obviously. But once you have the numbers for your company, and if you want to know what numbers, go look at that spreadsheet I attach. I'll attach it again. Basically, it's things like what's your cost of equity, what's your cost of capital. So basically, the numbers that you kind of nailed down as you went along. Send me that summary, because next Monday's class will just be a class where I show you your own numbers across the class. You know, how many of you found your companies to be under-levered? How many over-levered? What is the most under-levered company in the class? So to do that, I need your numbers. And obviously, I need some time to work on the numbers. So I need those numbers by Sunday midnight at the latest, right? Because that way I can work on the numbers on my way in and have the presentation ready to go on Monday morning. So I'm not asking you for the numbers right away, but the spreadsheet's there. Obviously, the sooner you can get the numbers to me, the sooner I can start. If all 300 summaries arrive on midnight on Sunday, I'm screwed. I'm not staying up all night to pull these numbers together. So I wake up in the morning, I'm going to wake up to 300 summaries. So if you can if you're done by Friday, don't hold on to the numbers, just send them to me. If you have one holdout in your group, you know the one I'm talking about, who really hasn't even picked a company yet, you're really terrified of what he's going to do to you, right? Send the rest of your numbers in, because I'd rather have some of the numbers rather than none of them. Okay? So let's put the closing touches on dividend policy, because I really want to jump in. And I meant when I said in that email, I want to take my evaluation class and see if I can summarize it into 2 sessions. So we were talking about dividends, and I said one of the ways you can look at whether your company is returning too much cash or too little cash is to look at what they could have returned, the free cash flow equity. Is everybody comfortable with what the intuition behind free cash flow equity is? The way I describe it, it's a cash left in the till after you've met every conceivable need. There's no other claim on the cash. This is potential dividend. So we looked at Disney, we looked at Vale. Now I'm going to bring in a company we haven't talked about, because it's a company that when I first did the analysis on, I was convinced that I must have messed up. It's British Petroleum. And it's actually an analysis I did in the early 90s, 92 or 93, on BP. This is actually for a presentation that I was doing for BP, so I decided to take a look at BP in all of its different facets. So I pulled up the net income, the net cap, everything you need for free cash flow equity. I'll cut to the chase. Over the 10 years, from 83 to 92, the free cash flow equity at BP was $571 million a year. So let's start with an easy question. How much cash can a company with $571 million in free cash flow, how much dividends can a company like that pay out each year on average? About $571 million, right? They paid out $1.5 billion every year for 10 years. This is where I thought I must have screwed up, because how does a company pay out $1 billion more than its free cash flow equity year after year for 10 years? You know how BP pulled it off? Is every year they'd go to the bank at the end of every year, borrow an extra $1 billion, not to take more projects, not to drill more wells, but to pay dividends they couldn't afford, year after year after year. There was one year in 1987 where they actually had one of the most infamous IPOs of all time. In those days, if you had an initial public offering, investment banks used to price the offering about 2 weeks before the offering date, saying, what can happen in 2 weeks? And of course, this IPO was priced to go public on October 21st of 1987. So the bankers set the price. And in the middle, October 19th of 1987 happens. For those of you who don't know what happened on that day, the S&P 500 dropped by 22%. You guaranteed an offering price. The market is down 22%. One of the most pathetic shows of lack of backbone, the investment banks went to the British government, which was the primary owner of BP at that stage, and said, we gave you a guarantee, but we really didn't mean it to hold in something this dire. It's like Can you imagine the analogy? You insure your house against a fire, the whole house burns down. The insurance guy comes around and says, this was a big fire, wasn't it? And you say, yes. We don't cover big fires. We cover small fires in the kitchen we would have, but this is too big a fire. This is exactly the reason why I pay an investment banking fee to provide the guarantee. To give the British government credit, they held the investment banks to their promise, and in that year they raised $1 billion in equity to do what? To pay dividends. Do you think this is a problem, to be paying out $1 billion more in dividends every year than you can afford to? It's obviously a problem. My second question is, it's not a hidden problem. Everybody at BP knew they had a dividend problem. Everybody, including the janitor. You know how he knew? Because whenever he wanted a new broom or a new vacuum, he'd go upstairs and they'd say, no new vacuum this year. Why? Because we need every dollar to pay dividends. Everybody in the company knew there was a dividend problem. So why was nothing done about it sometime during this period? Let's go back to 1986. We already know we have a dividend problem, right? Let's pull up a top management meeting at BP. We're all sitting around a table. So you thump the table. Oh boy, we have a dividend problem. I don't have my Oxbridge accent on, but you know, it's Lord so-and-so, Viscount so-and-so. Everybody around the table, aye, everybody agrees you have a dividend problem. You've got to cut dividends. Aye, everybody thinks it's a great idea. Nothing happens. And here's why. I'll give you a story. This was one of my favorite stories when I was a little kid. It's about these mice who live in an abandoned house. And a cat moves in. Don't ask me how the cat found out that the mice lived in the house, but no, it has its information sources. It moves in and starts terrorizing the mice. So the mice decide that they should do something about the cat. They call a mice meeting, probably very chaotic. One of the mice says, look, we've got to do something about the cat. So one of the more brilliant mice comes up with an idea. He says, let's put a bell on the cat. That way we'll know when the cat's around. We can all go hide when he's around. Then one of the more practical mice asks the key question, which is, who's going to put the bell on the cat? Not me. Let's go back to the BP meeting. We should cut dividends. Aye. Everybody agrees it's a great idea, until somebody asks, well, who's going to tell the stockholders? You think, what's wrong with telling the stockholders? You have an insane dividend policy. Why can't you go in front of your stockholders and tell them you have an insane dividend policy? Because remember what we said, you get the stockholders you deserve. BP, during these years of paying huge dividends, attracted people who didn't just like dividends, they were addicted to dividends. You got every dividend addict in the world in this room, and what are you going to tell them? I'm going to take your dividends away. You're not going to make it out of this room alive. So suddenly everybody gets cold feet. Maybe something good will happen, which for an oil company is what? Maybe oil prices will go up, our problem will go away. There was a brief period in 1992 when Saddam Hussein wandered into Kuwait, oil prices jumped, and BP thought its dividend problem had gone away. You could see people dancing on the desk, no more dividend problem. Then, of course, a few weeks later, it was back. We all agree that this is a dysfunctional dividend policy, right? From a corporate finance standpoint, we all agree that you should cut dividends. You can't sustain this. To show you there's no justice in the world, BP eventually did cut dividends in 1992. You know why they had to cut dividends? Did somebody come to their senses that we have to do the right thing? What do you think led to the cut in dividends? Every year, how did they fund these dividends? They went to the bank, they borrowed money. By the end of 92, BP was the most highly levered oil company in the world. And when they went to borrow an extra $1 billion to pay dividends in 92, the bank said no more. They cut dividends, but here's the unfair aspect of it. They cut dividends, we all agree they should do it, the stock price drops. It plummets. To complete the story though, it dropped and kept dropping for about 6 weeks, and eventually it came back up. It was in fact the best thing they could have done. They went back to being a healthy oil company. But during that period, and Cam I think mentioned this in the last session, there is this point where new stockholders are coming in who are willing to accept your lower dividends, but that transition phase is painful. And during that period, half of BP's top management lost their jobs. Now you see why managers, even though they know what the right thing to do is, often are reluctant to do it, because by the time the market comes around to accepting that it's the right thing to do, you've lost your job. This is at the core of dysfunctional dividend policy. So when you look at companies that pay vastly more than they should, and you say, are they insane? Well, partly they are, but partly it is this reluctance of being the one who makes that big decision and having to bear the pain of that decision that holds managers back. In fact, one of the most interesting things that people have studied is if you want to cut dividends, what is the best way you package a dividend cut to the market? You see, I mean, let's say that you see that you have to cut dividends. So this is actually a study that looked at cuts in dividends and looked at how the market reacted to cuts in dividends and looked at what else was packaged with the dividend cut. If you announce a dividend cut and simultaneously also announce that your earnings have dropped across the board, it's bad news, 8.17% drop on the announcement period. If you previously announced an earnings drop, it's still bad. But if you announce a dividend cut and say, look, you're cutting dividends because we have great projects, the initial reaction is still negative. It's like the market doesn't believe you. But if you are in fact going to follow through and show those good investments, what you lose on the announcement period, you more than make up in the subsequent quarter. In other words, the best reason for a dividend cut is that you have good investments. But don't expect markets to cheer you right off the top. Because who can blame markets for being skeptical? Everybody claims to have good investments. You need to be able to follow through and show some tangible evidence that you really mean what you said, that you're taking investments with this cash you cut back. So there are no easy ways to cut dividends because no matter what your motive is, at the time of the dividend cut, the stock price seems to drop. So that's what the announcement period is. And it drops even leading up into this because there are rumors of dividend cuts. It's only in the period after that you start to see separation in companies that cut dividends for the right reasons and companies that cut dividends because they had no choice. Any questions? Let's do one other example, actually two more examples, but let's start with the limited. Now this is a company we haven't talked about, but the limited and the gap were the growth stories of the 1980s. There were companies that grew fast and were growing well, were opening stores in malls across the country. So this is the limited during their glory period. They were growing from being a small company to a big company, and their free cash flow equity on average over this 10-year period was minus $34 million. We just made dividend analysis really simple, right? If you have negative free cash flow equity, you should not be paying dividends. Well, the limited during this period paid about $41 million in dividends a year. Why would a company with negative free cash flow equity pay dividends? Let me start you on the story that probably got them started as well. So you're the limited, it's 1982 or 83. You're a young growth company. You pay no dividends. You need every dollar of cash flow to grow. You're putting it back into the business. I show up at your office and say, look, if you don't pay dividends, there are investors out there who cannot buy your stock. Is that true? Yeah, it's true. There are some pension funds, for instance, that cannot buy stock in companies that don't pay dividends. So here's what I suggest you do. I say, look, I know you're a growth company. I know you can't afford to pay dividends, but why not pay a token dividend, a small dividend? You see how this seems like you can have your cake and eat it too? By paying a small dividend, you can now show up on the lists of those people who otherwise would not be able to buy your shares. That increases its demand supply, right? So if more people are interested in your stock price should go up. So I'm going to throw this question back to you. If this is the advice you're getting, you're a young growth company, you really can't afford to pay dividends, say, just pay a token dividend. What can it do? It can't harm you that much. Why should you push back? What's wrong with doing this? How do I describe those investors in BP? I call them addicts, right? What happens if you offer an addict just a token? Just a little bit of cocaine, but stop there, please. The definition of an addict is you offer a little bit, they want more. That's exactly what happened at the limited. They started with $1 million in dividends, a token dividend. Who bought the stock? People who like dividends now bought the stock because you're now on their list. Now they're in the room, and what do they want next? They want more dividends. That $1 million in dividends over the 10 years became $101 million. What's the lesson you take out of this? If you cannot afford to pay dividends, don't go looking for trouble. There are enough investors in the marketplace who are okay with you not paying dividends. Don't go looking for people who want dividends, because I don't blame them for demanding more in dividends. I blame you for inviting them into the room, because once they're in the room, they are going to ask for more dividends. That's what they come for. That's how they measure their investment returns. So many of you are actually valuing young growth companies. As I looked at the list of the companies that you picked, and many of those companies have negative free cash flows equity. Some of them are paying dividends. And it might be worth exploring whether this is the process that got them started. Because once you get started, it's very difficult to step back from the process and say, we're going to cut back dividends to zero. Okay. Any questions? Last example here is Tata Motors. Okay. So I computed their free cash flow equity. Their free cash flow equity before debt was actually minus 106 billion. Their free cash flow equity with debt included was 825 billion. And if you use the target debt ratio, is about 48 billion. All of this, though, has to be compared to what they paid out as dividends. And basically, over this 10-year period, they paid out more in dividends than their free cash flow equity before debt payment. So part of the way they funded these dividends was by borrowing money. But let's say they hadn't borrowed the money, that they were paying out more than they could afford to. You know, the problem with Tata Motors is I cannot, just as with capital structure, I have no idea what's going on unless I step back and look at the entire group. There are, for instance, if you look at Tata Consulting Services, which is the largest piece of the Tata Group, they have huge free cash flows equity and pay out very little of those cash flows. You think that's good? They're a growth company. Much of that cash, though, is not really invested in Tata Consulting Services. They don't need the cash. It's a low reinvestment business. That capital, though, can find its way into Tata Motors, Tata Steel, Tata Chemicals. The group is funding other companies within, and there's nothing, again, you can do about it. And that goes back to the corporate governance question. If you have no power in a company, even if you don't like the way the company is set up, there's not much you can do about it. So 5 different companies. Disney was holding back cash, then was paying out too much in cash, was holding back cash again. You can see how companies shift. Vale is paying out too much in dividends. We can all see that. But because of their control structure, they are in a very dangerous place. They don't want to cut dividends and give up voting rights. But if they don't cut dividends, they're going to be in serious trouble. Okay? We looked at BP, a company that was paying out too much in dividends but couldn't step back, because once they started paying the dividends, they attracted an investor base that really liked those dividends. And we saw what happened. The Limited, young growth company, negative free cash flow equity, started paying dividends. It took on a life of its own. And we ended with Tata Motors, a family group company, where what you observe as dividend policy reflects what's good for the group, not necessarily what's good for the company. So at the end of the process, here's what I did. I went back to that matrix. Remember the matrix that I showed you, where on one axis I look at whether your company is paying out too much or too little. And the other, I looked at what quality of projects you have. So it's actually a great way if you have 6 companies in your group with very different characteristics, so you can compare them. So remember, the companies that have the maximum flexibility are companies like Baidu, which are accumulating cash but are delivering returns way above their cost of capital and have good stock returns. The companies that are in the most danger, in my case I don't have any, are the companies with a poor project with a cash surplus. And of course, you have the cash deficit companies. Deutsche is now a cash deficit company with bad projects. And you have Disney, Vale, and Tata Motors all in that bottom box, because they all pay out more than they can afford to. And they all have good projects. Any questions? So here's the second to last piece of your project is once you have the numbers for your company, look at your free cash flows to equity. As I said, it's fairly straightforward. You have the statement of cash flows. Do it for 3 years or 5 years. Some period we get some smoothing out. Look at what they actually return in the form of dividends and buybacks. And given what you already know about the company in terms of the Jensen's alpha, so bring in all that ammunition. Don't treat each module of the project as if it's a separate module. It's all part of the story about the same company. See if you can tie the story together. I'm going to use that word repeatedly today, which seems like a strange word, because you're telling a story about your company, and everything you know about the company becomes part of that story. Okay? So that's dividend analysis, and I call it intrinsic dividend analysis because you look at the free cash flow equity, you look at what's paid out, you ask the question, should my company be returning more or less cash? But I also said right at the start that the way most companies decide how much to pay in dividends is they look at everybody else in the sector. In fact, it's becoming true even with buybacks. The way companies decide whether to buy back stock is they look at whether everybody else is buying back stock. A really dangerous place to be. But that's where many companies choose to be. So what I did was I took my 5 companies. I looked at the dividend yield and the dividend payout, the 2 measures of dividends that we had for the companies versus the group. So let's take Disney. Disney's dividend yield is 1.09%. The dividend yield for the sector is 0.96%. Its payout ratio is 20. It's actually very close to the sector in both yield and payout. If you look at Vale, much higher dividend yield on a dividend yield basis, but a payout ratio, both the company and the sector are paying out more than their earnings. The payout ratio is more than 100%. Reflects the fact that some of this is not just a company-specific problem, it's a sector-wide problem, that these companies somehow hope that prices are going to go up, commodity prices are going to go up and bail them out. If you look at Tata Motors, its dividend yield and payout ratio are less than the sector. Read into it whatever you might want to, but that's basically what the comparison tells you. For Baidu, of course, no dividends, but the sector itself is a low dividend paying sector. The dividend yield is 0.09%, and the typical technology company pays out less than 10% of its earnings as dividends. And with Deutsche, both the company and the sector have high dividend yields, but Deutsche is in much worse shape than the rest of the sector because its payout ratio is actually 316%. Remember we talked about how dividends follow earnings? It took Deutsche until 2015 to actually cut its dividends to reflect the troubles it was in. It wasn't until 2016 that they finally said no more dividends until we get back to some degree of semblance. But it took them that long between the time they got into trouble, which was 2012, 2013, for the dividend policy to reflect the troubles they were in. Okay? So I actually took the Disney peer group and I looked at dividends. So basically just to get a sense of what does the sector look like. So you can see the dividend yield and the payout ratio, the second and third column. In the last one, I actually compute a ratio that you won't find in most services. I take dividends plus buybacks. I call that cash return, and I divide by the free cash flow equity. If that number is 100%, the company is paying out its potential dividends. If that number is greater than 100%, at least for this year, the company paid out more than its free cash flow equity. So for BP, this number is going to be 300%, right? And if that number is less than 100%, the company is accumulating cash. So it's a quick, again, a quick way of measuring whether your company is holding back cash or returning more cash than it should. Finally, I took the all U.S. companies. Remember how I ran that regression across the market with debt ratios? I took all U.S. companies and took the payout ratio and the dividend yield for U.S. companies and ran a regression across the entire market. I'll give you the bad news first. The R-squareds are not great, but they're better than the debt ratio regressions. The R-squared is about 20 to 25%. Payout ratio, I regressed against beta, growth, and how much debt they had. So the higher the beta of the stock, the lower the payout ratio. High-risk stocks pay out less in dividends. The higher the growth rate, the lower the payout ratio. Again, that makes sense. Higher growth stocks pay less in dividends. And finally, the more debt companies have, the more they tend to pay out in dividends. Both in terms of, and that again is not surprising. Mature companies tend to borrow more money than high growth companies. So that might just be spurious correlation that you're seeing there. But basically what I tried to do is find variables that explain differences in yield and payout. And there are my regressions for the entire market. You're saying, well, how does that help us? If I plug the numbers for Disney or any company into these regressions, I'll get a predicted debt ratio. In fact, I took Disney's beta, growth, and debt to cap. I got a predicted payout and a predicted dividend yield, given how the rest of the market is behaving. And if you look at those numbers, it looks like Disney is pretty close to what the market is doing. It's just like on the debt ratio. You're getting a measure of Disney. I mean, whether they do it intentionally or not, they're pretty close to where the rest of the market is in terms of how much they pay in dividends. But what we're missing here, of course, is the buyback portion, the fact that they buy back huge amounts. So when you look at the dividends of your company, more than any other aspect of what you look at your company, you might find things that don't make sense. And sometimes the reason for that lie in their history. They started paying a lot of dividends. They no longer can afford to pay those dividends, but they're kind of stuck with that policy because it's so difficult to step away. So let's turn to valuation. I love teaching corporate finance. I mean, obviously, I've been teaching it since '84. But valuation is my baby. It's a class I created at Stern. There was no valuation class until 1986 when I started this class at NYU for the first time. So this will be my 53rd semester teaching valuation. Often I teach it 2 times a year. And one of the things I've learned about valuation is the more you learn about valuation, the less time it takes to actually teach the class, because the more you realize there's not much there. So I'm going to give you my perspective on valuation, because one of the reasons I think one of the things that I find troubling about valuation is increasingly people have taken modeling and made into valuation. What I mean by that is basically building big Excel spreadsheets has replaced valuation. So I'm going to take a little tangent here and talk first about why valuation matters in corporate finance. It matters for a simple reason. If you believe that the objective in corporate finance is to maximize the value of a business, we've kind of talked around that word all through the class, but we've really never valued Disney or valued Baidu or valued Tata Motors yet. So I want to kind of bring them all together. And as I do it, I'm going to argue that when you look at the value of a company, embedded in that value are all of the things we've talked about in this class. How you take investments, how you finance them, how much you pay in dividends. So part of my job is to actually take the numbers in valuation and kind of reverse from them all the things we've talked about in corporate finance. In other words, if you take better projects, it should show up in your value, right? So I have to give you a pathway to show how your choices in investing, financing, and dividends show up in value. Right? There are 3 ways in which you can put a number on a business. The first is intrinsic valuation, where you value a company based on its cash flows, growth, and risk, which is an extension of what we did in capital budgeting. When you build a discounted cash flow model, if you truly mean what you say, you're doing an intrinsic valuation of a company. 95% of what you see out there as valuations are not intrinsic valuations. They're what I call pricing or relative valuation. In pricing or relative valuation, you attach a number to a company based on how other companies are being priced out there. The way this manifests itself is you'll see analysts using multiples and comparables. PE ratio, EV to EBITDA, price to book, and comparables. That's pricing. And there's very little in valuation that's new or different, but the one area in valuation where we've kind of made advances in the last 40 years is we've been able to borrow tools from option pricing to value certain kinds of businesses. Like what? You give me a young biotechnology company to value. How young? It has no revenues, no earnings, no cash flows, but it's got a blockbuster drug working its way through the pipeline. I'm going to argue you're really buying an option. Why is it an option? Because it's contingent on getting approval. You buy Petrobras today. I'm going to argue you're buying partly an option. An option, why? Because there are all these undeveloped reserves, many of which are not, given today's oil prices, you might never develop. But the fact that you won't develop them today doesn't mean they have no value. You're buying an option when you buy those undeveloped reserves. So you've got intrinsic valuation, you've got pricing, you've got what's loosely we call option pricing and valuation, or real options. I want to focus just on the intrinsic value part, at least for the moment. And I'm going to do it first by taking you on a tangent before we actually bring things into mechanics. Right? I'm going to start with a question I ask all my valuation class. And usually I'd have waited till you were in my valuation class to ask this question, but since you're not going to be there and I'm not going to be there, I'll ask you this question right now. If I asked you to classify yourself as a person, would you more naturally classify yourself as a storyteller or a number cruncher? Think about it for just a moment. There's no right answer. Look inward. Are you more naturally a storyteller or a number cruncher? You're saying, I don't know. You've known for a long time. Okay? I knew when I was probably about 13 or 14. It was right after my first English literature class. I was asked to read Moby Dick. And I did. I was a good kid. I listened. So I showed up in class, ready to talk about whales and captains. That's what I thought the book was about. And I remember 15 minutes into the session, there was not a mention of whales and not a mention of captains. And the instructor kept going on and on about hidden meanings in the book. I remember sitting there saying, really? That's what Herman Melville was thinking when he wrote that? And I remember walking out of that class with a singular reaction. I said, never again am I going to subject myself to that kind of bullshit. And the rest of my high school life was laid out for me. I avoided the literature classes like the plague. Who wants hidden meanings? I went Algebra 1, Algebra 2, Algebra 3 out of high school. And these were the good old days where you could go to college and not have to deal with the crappy core curriculum that they make you deal with today. You know what I'm talking about? For the first 2 years, you're required to take classes and things you're not in the least bit interested in. Things like biology, you have to take. Why? You're required to do it. Spanish, why? It's really a way of, I'll give you the real reason. It's without those core curriculum, history departments would cease to exist. I mean, let's face it. I mean, who, as an elective, is going to, I want a history class? Maybe you do. But that's the difference between storytellers and number. So I was a number cruncher. I went on to college. I took number crunching classes. And if I hadn't ended up where I did, I would have ended up in a number crunching job. And many of you followed the number crunching route. You became engineers, accountants, bankers, actuaries, number crunching jobs. But there were people in that class who loved the hidden meaning stuff. They thought this was great. They're the poets. They're like my youngest son is a poet. He writes very good poetry, though I can never tell. He showed me the first poem he wrote, and I don't think he's ever going to show me a poem again. He showed me the poem, and I said, Kiran, I think there's a problem. The words are supposed to rhyme, aren't they? To me, that's the definition of poetry. It's like, it's like the rhymes they teach you when you're a little kid. He said, Dad, you're not a poet. I said, you're right. So they're the storytellers, and they take that class, and they love it. Literature 1, Literature 2, Literature 3. They go on to be history majors at Yale. They graduate with a history major, and they discover that even Yale history majors don't make much money. So here's what happens. The number crunchers go off into the number crunching jobs. After about 4 years, they're incredibly bored with entering numbers into spreadsheets. They come back here. And the storytellers go work, find they're paid poverty wages, they come back here. And one of the nice things about the valuation class, when I ask this question, it kind of splinters down the middle. Not quite. This is selection bias. About 60% are number crunchers, about 40% are storytellers. And of course, the number crunchers think that they have the upper hand. This is a valuation class, after all. And that's when I have to let them in on what I think is the biggest hidden secret in valuation. Valuation is never, or should never, be just about the numbers. At the same time, valuation can never just be about the stories. A good valuation is a bridge between stories and numbers. Let me explain what I mean by that. If I show you a valuation of a company, and I will show you valuations of all of my companies, and you point to a number and say, why is the revenue what it is in year 10? You know what my answer should never be? It's because I used a 15% growth rate for the first 5 years and 6% thereafter. That is no answer. You need to tell me your story about the company that animates that number. And if you tell me a story about the company, then I push you on and say, where is it going to show up in the numbers? I need you to tell me where it's going. So you tell me your company has a strong brand name. What does that mean? Where are you going to show it in your valuation? It's great management. Show me where you're going to show it in the numbers. To me, that is the key to valuation, is connecting stories to numbers. So when I teach the valuation class, my end game is very simple. I say, by the end of this class, here's what I hope will happen. I hope the storytellers develop enough number crunching skills that they develop some discipline. You can see why, right? The problem with storytelling often is it's so easy to wander across the line between fact and fantasy, to tell fairy tales because the story is so good. So you develop enough number crunching skills that you develop some discipline. You want disciplined storytellers. And then I turn to the number crunchers. By the end of this class, I hope you redevelop an imagination. Because let's face it, you've spent a lifetime bludgeoning that thing into the ground. Because to you, storytelling is the essence of weakness. An equation is that me? Storytelling is a sign, is that better? I think so. Right? Is a sign of weakness. So by the end of the class, I hope you have imaginative number crunches. That to me is what makes for somebody who's good at valuation. Disciplined storytellers or imaginative number crunchers. I told you it's the 53rd semester I'm teaching this class. Guess who I have more trouble with? Getting storytellers to develop discipline or number crunchers to develop an imagination. It's not even close. You give me 100 history majors, I can teach them enough valuation in a day that they are out there valuing companies tomorrow. You give me 100 engineers, I am dead in the water. Because it's nothing to do with me or the material. It's got to do with you fighting your own battles, because telling a story has become such a foreign concept to you. I told you I was a number cruncher when I started. In fact, when I first started teaching the class, I taught it like a number cruncher teaches the class, which is what? All numbers all the time. When in doubt, put in an equation. When in further doubt, add some decimals. You feel like you're in control? It was only about 5 or 6 years into this class that I realized I had a problem. And you know how I knew I had a problem? I could value just about any company, but I had no faith. See, what does that even mean? Why do we value companies? Is it because we're intellectually curious? Maybe you are. I am not in the least bit. I don't lie awake and say, I wonder what Facebook is worth right now. Maybe you do. We value companies for one reason and one reason alone, which is you want to act on those valuations, right? If you find something undervalued, you've got to be willing to buy it. And I discovered I had no faith. I could value a company, but it was just a collection of numbers to me. I knew how easily I could move that number by moving my revenue growth or margin. I had no faith in the sense I was unwilling to put money behind my own valuations. So that's when I had to teach myself storytelling. And the first time I did it was like pulling teeth. It still doesn't come naturally to me. When I sit down to value a company, my first instinct is let's open the spreadsheet, let's go off to the races. Okay? But the reality is if you want a good valuation, you need to start with a story. So I'm going to take you through the mechanics of valuation. Master the mechanics, but to value a company, you need to start with a story. And I'll help you by giving you my stories for Disney and Tata Motors and Deutsche Bank as I do the valuations, so you can see the numbers stem from the story. Because the story drives the valuation rather than the other way around. So when you think about valuing a company, here are the 4 pieces that go into value. And these are the mechanical pieces. The first is you have cash flows. You have existing investments. What are your cash flows from those existing investments? So if I'm going to ask you questions, that's the first question I'm going to ask you. You've already made some investments. What do those cash flows look like? Those cash flows obviously have to be after taxes. And if you're valuing the entire business, they have to be before debt payments. Same principle that applies how we thought about cash flows and discount rates when we talked about capital budgeting. What are your cash flows from existing assets? Second question I'm going to ask you is, what is the value that you see from your future growth? And what are the 3 possible answers? One is, it could be a lot if you're a growth company with great investment opportunities. It could be 0. And when is that going to be true? Either when you have no growth or when you have growth, and what's true about that growth? You earn a return on capital roughly equal to your cost of capital. It's like you're running in place growth. Or worse still, it can be value destructive, where you can grow and actually destroy value as you're growing. Why? Because you're taking projects that earn less than the cost of capital. So notice how I phrase, what's the value of growth? I didn't say what's your growth rate, because that's an easy answer. I'm asking, what is the growth rate, and are you actually going to create value? Third question I'm going to ask you is, how risky are your cash flows? Notice I didn't ask you what your beta was. You could decide that beta is the way you want to measure risk, but how risky are your cash flows? And finally, I'm going to ask you, when are the good times going to end? When will you be a mature company? You see, why do you want to know? Because if you look at that equation, what does it say? The value of an asset is the present value of the expected cash flows over its lifetime, right? You're valuing a publicly traded company. At least in theory, the life of a publicly traded company is forever. You cannot estimate cash flows forever. So what do? Usually in valuation, you stop at some point in time. You can't arbitrarily stop. You can stop if you're willing to make an assumption. And this assumption is going to scare you just as it scares most people. The assumption you have to make is beyond that point in time, whatever that point in time is, 5 years, 10 years, your cash flows are going to grow at a constant rate forever. Remember we talked about what that buys you, right? If your cash flows grow at a constant rate forever, you have a growing perpetuity, an infinite series. And the present value of the growing perpetuity you can capture with that equation we used when we did the Disney theme park, that present value equation. So when I think about value, I don't think about a spreadsheet. I think about answers to these 4 questions. What are your cash flows from existing investments? What's the value of your future growth? How risky are your cash flows? When will you be a mature company? Right? And you can already, when you think about the company you're looking at, you can already see the answers can be wildly different depending on whether you're valuing a company like Tesla or whether you're valuing a company like Ford. When you're valuing a company like Ford, the bulk of your value is going to come from cash flows from existing assets. Much of what they do is already on the ground. When I ask you what's the value of growth at Ford, if you're optimistic, you might say it's 0. If you're pessimistic, you're going to say it's going to be less than 0 because you're investing money in all this stuff and you're earning less than the cost of capital. I ask you how risky the cash flows are. The risk for Ford comes primarily from macro forces. The economy is going into recessions, so you're going to capture the risk. And when I ask you, when will you be a mature company? What's the answer with Ford? That was 10 years ago. I'm beyond mature now. Basically, you're in steady state. I don't have to build an elaborate discounted cash flow model. I can value you as a mature company today. But when I ask those same 4 questions about Tesla, you can see how the answers become much messier. When I ask you, what are your cash flows from existing assets? Well, they're probably big negative numbers. We got that out of the way. When I ask you, what's the value of growth? It could be huge. It could be negative, depending on your perspective on Elon Musk and what he can pull off. Yesterday, I was reading about Tesla's new solar roofs. Have you seen this? I'm not even sure. So I'm telling a story about Tesla. When I first valued Tesla 3 years ago, the story I told was of an extraordinarily innovative electric car company. But today, I'm not sure that that story holds. Maybe it's a green energy company that's going to produce batteries, it's going to produce roofs, it's going to produce cars. Your stories can change over time, and your stories change, your value has to change with it. Now, how risky are the cash flows in Tesla? In the case of Tesla, it's not just macroeconomic risk, it's technology risk, it's management risk, layers of risk you wouldn't have had to deal with in the case of Ford. So when will you be a mature company? That's a tough one to answer. It could be in 5, it could be in 10, it could be in 15 years. You can already see why valuing Tesla is going to be more difficult than valuing Ford. Just a different stage in the life cycle. But think about those 4 questions when you think about sitting down to value a company. So let's set the table. There are 2 ways you can approach valuation. And they're very similar to what we talked about in the context of capital budgeting. The first is to value just the equity in the business. What does that mean? So let's say this is a company. You guys are equity investors in the company. You guys are bankers, lenders to the company. To value the equity in the company, I focus just on you. I look at the cash flows you get from the company, cash flows to equity. Now do you see how what we've already done is going to help us? The free cash flow to equity is a rough measure of what you generate as cash flows. You discount those cash flows to equity investors back at the cost of equity. The same cost of equity we've been using all the way through the class now becomes the cost of equity I used to value the equity. What I get as a present value will be the value of equity in the business. In fact, if you're an old-fashioned investor, you might say, look, all this free cash flow to equity stuff is too complex. What's the only cash flow you actually see as an equity investor in a company that you get in the mail? It's dividends. The dividend discount model is a very special case of an equity valuation model. Where you discount dividends back at the cost of equity, you're done. But as we saw in the dividend section, a lot of companies don't pay out what they can afford to in dividends. If I took Google and I said, look, they don't pay dividends, the stock's worth nothing, that's kind of a silly place to end up in. But that's part of the reason you might want to look at an expensive definition of cash flow, which is the free cash flow to equity. So that's an equity valuation. You can also value the entire business. What does that mean? You look at the collective cash flow that both of you made out of the business. You made free cash flow to equity. What are the cash flows you got as lenders? Interest payments and principal payments. A collective cash flow, a pre-debt cash flow, is the cash flow to the firm. If that is the cash flow that I'm discounting, the discount rate I should be using should be a weighted average of what you wanted, the cost of equity, and what you wanted, which is the cost of debt. which of course is the cost of capital. Cash flows to the business, discounted at the cost of capital, gives you the value of the entire business. You've got to make that decision early in the process because every input into the model is going to be determined by that choice you make as to whether you want to discount the cash flow to equity or cash flow to the firm. I'm going to push almost all of you, unless you're incredibly stubborn and you want to do it on your own, to try to value the entire business for your company rather than value equity. And the reason for it is very simple. To value equity, using the free cash flow to equity, you actually have to make assumptions about debt ratios changing over time. Right? If you assume that debt ratio is going to go up, it makes cash flows to equity really messy to compute because you now have to compute new debt issues and debt repaid. Remember those two items you needed for free cash flow to equity? When you do free cash flow to the firm, you can just estimate the cash flows and not worry about debt. Why? Because they're pre-debt cash flows. But here's where it's going to show up. What's your cost of capital? It's a weighted average of your cost of equity and your cost of debt, right? And you use a debt ratio. If you think the debt ratio is going to change over time, let's say you're valuing Netflix, and you think that over time the debt ratio is going to decrease or increase, you can actually change your debt ratio, but in your cost of capital rather than your cash flows. The cash flow to the firm, the firm valuation approach is a more flexible approach because it allows you to deal with changes in debt ratios much more easily. So we're going to value the entire business, and I'll also tell you that if you do this right, you should get the same value for the equity at the end, no matter which approach you use, but this just gives you more flexibility. Yes? Okay, that's a good question. You know what, for the highly cyclical firms, what the most difficult thing is? Getting last year's earnings. It's really not the future cycles that I'm worried about, it's past cycles, and here's why. If you have a highly cyclical company and last year was a recession year, your earnings are going to be crappy, right? If I take those crappy earnings and make that your base year earnings, the rest is almost pointless because I'm going to come up with a really low value for your company. Conversely, if last year was a peak year and I take those earnings and build them into my valuation, my values are going to be too high. I'm going to normalize the earnings. It sounds fancy, but I'm going to look at what you made across the cycle. So for Ford, rather than take last year's earnings and use that as my base year, I might look at the average margins they earn across the cycle. Let's say that on average they earn a 6% margin. Take the revenues from last year, apply the 6% margin to it, and say that's what I make in a normal year. But I'm not going to try to forecast future cycles. You know why? When is the next? Are we in a recession or a recovery? It's already, I'm not even sure. When will the next recession be? I have no idea. And my problem with trying to forecast cycles is you're no longer valuing a company. You're a macroeconomist, and we know how good their track record is. Why do you want to join those guys? So my view with cyclical companies, I'm going to normalize the earnings. Look at economic cycles. I have no way of predicting them. I'm going to look at your growth across cycles. So if you're Ford, across recoveries, and you're probably going to grow 2-3% a year. It's not. So I'm going to apply a normalized growth and normalized earnings and hope the rest takes care of itself. Okay. So when you have cyclical, and I'll say the same thing about commodity companies. You're valuing an oil company like Royal Dutch or ExxonMobil or Lukoil. The last thing you want to be doing is forecasting future oil prices and bring them into your valuation. Because nobody can get that right. Might as well value the company given the prices you're at, rather than the prices you wished you were at. So we're going to value the firm. Yeah.
You mentioned that 95% of the valuation is done by
By pricing. Let's not use the word value at all. In fact, I think we should not use the word value there. You're pricing the company. All right.
So what is the main application of?
If you're buying a business, right? The whole idea of investing is you buy a business. There are two games you can play in the market. One is called the pricing game. The other is called the investing game. In the pricing game, how do I decide whether you're a winner? You buy at a low price, you sell at a high price. You won the game. I don't ask you why you won. You know how you might have you might be looking at technical analysis. You might be looking at charts to make that judgment. So in the pricing game, it's all about getting the pricing right. So if you're an equity research analyst, you're a portfolio manager, you're a venture capitalist, that's how you get judged, is do you play the pricing game well? There's another game you could play. It's a different game. It requires a much longer time horizon, and it requires a different perspective, which is when you buy Tesla, you're buying a business. You don't care what other people think about the business. You're buying a business. You're buying it for its cash flows, growth, and risk. It's a different game. It's a much more long-term game. There are very few investors out there who play it because you might not have the patience or the capital to play that game. So if you're doing intrinsic valuation, you're playing the investing game, and it's a game that very few portfolio managers or equity research analysts get to play. Okay? But that's the game that lies under the pricing game. That's the reality under the pricing game, and eventually reality wins out. Okay? So that's why we need to know the value, even though we might be playing just the pricing game. Any other questions? So let's look at the ingredients that determine value. And here's what I'm going to do. I'm going to divide this part of the class. You're going to be valuing the firm. You guys are going to value equity. And with each ingredient, we're going to look at how you measure numbers for the cash flows, growth, and risk. And you're going to see how your choices up front drive those numbers. So when I ask you, what are your cash flows from existing assets? When I look at equity investors, the cash flows you have to think about are cash flows after interest payments, after principal payments, cash flows to equity. But when you look at cash flows when you're valuing the firm, the cash flows you're looking at are before debt payments, because to you, debt holders are part of the business. Already you can see how the numbers are going to be wildly different at highly levered firms. When I ask you, what's your expected growth rate going to be? As equity people, your growth rate has to be growth in equity income, net income, earnings per share. But when I ask you, what's your growth in earnings going to be? Your growth rate has to be in operating income, because that's what you care about as the entire business. And the numbers can be very different. And ask you, what discount rate should I apply on these cash flows? Because you're equity focused, you think about the cost of equity. But because you're valuing the entire business, when I ask you what the discount rate is, your answer is going to be the cost of capital, two different numbers. When will you be a mature company is the same answer to both. But in one case, you're telling me your cash flows to equity will grow at a constant rate forever. But when you're talking about the entire firm, you're talking about the cash flows to the business growing at a constant rate forever. That's why this choice has to be made first before you start jumping in and estimating the numbers. So let's start with cash flows. I mean, obviously, if you're doing a discounted cash flow valuation, it's got it. And much of what we're going to say in the next few minutes, you've already seen in other contexts, but you're going to see it come back in the context of valuation. Your cash flow that you use in a valuation can either be cash flow to equity or cash flow to the firm. Cash flow to the firm is after-tax operating income. See, operating income net of taxes minus net capex. That's basically what you're putting back in the business. We talked about in the context of free cash flow to equity minus change in working capital. If I did cash flow to equity, here's what it's going to look like. It's going to start with net income minus net capex. That's actually the free cash flow to equity definition. Compare those two definitions. Free cash flow to the firm, my measure of earnings is after-tax operating income. Free cash flow to equity, it's net income. Why? Because net income belongs to equity investors, operating income belongs to the business. I subtract out net capex and change in working capital from both cash flows. But if I'm doing free cash flow to equity, I also have to factor in debt coming in and debt leaving. So that's why I have the last item. Free cash flows have to be computed by you and I. And that makes people uncomfortable. Why? Because they're saying, what if I'm wrong on capex? What if I'm wrong on depreciation? What if I'm wrong on working capital? And at least in the context of free cash flow to equity, people sometimes cheat. They say it's too much work trying to estimate those items. So what I'm going to use instead is just the dividend and act like it's my cash flow to equity. Or in the last few years, increasingly, people have tried to add back buyback, saying it's cash flow as well, and I'm going to look at it across time. Cash flow to equity, cash flow to the firm. Okay. So let me start with Deutsche Bank in 2008. I told you that with each of my valuations, I'm going to tell you a story. And as we go through time, you're going to see my stories evolving. In October of 2007, when I valued Deutsche Bank, I valued it as a mature bank run by sensible people. Let me explain what I mean by this. Mature bank in the sense, it's one of the largest banks in the world, so I gave them a growth rate that reflected. Run by sensible people in what sense? I assumed that what they paid out as dividends is what they could afford to pay out. You see how that makes my life so much simpler? Is if I assume banks are run by sensible people, I can take the dividends, discount them back at the cost of equity, and say, I'm done. I don't have to worry about these regulatory capital things because it's going to be taken care of. Banks are run by sensible people. They're regulated by sensible people. So in 2007, when I valued Deutsche, I valued it using a dividend discount model as a large mature bank. In November of 2013, that obviously shifted. By October of 2016, which is the valuation, you're going to say, you can't talk about Deutsche as a mature bank run by sensible people because that is history now. So in October of 2016, Deutsche was in serious trouble. I could not assume that they could pay dividends because they couldn't afford to pay dividends. So I actually had to do the cash flow estimation by myself. So let me take you through the process, and we've done this before in the context of both dividend policy and capital structure. But to estimate the cash flow equity for Deutsche, here's what I did. I took their existing net income, which was a loss, minus 8.85 million, and they were losing a ton of money. And I projected out that return on equity improving over time. Why? Because they're still a big bank. They still have huge resources. I'm assuming in my story that Deutsche is going to make it back to health. You're saying, what if it doesn't? Hold off on that. We'll talk about how to bring that in. But I'm assuming that over time they'll find a way to nurse themselves back to health. And in steady state, this is my best case scenario, they're going to end up earning a return on equity roughly equal to their cost of equity. So I'm not asking for miracles here. I'm not even asking that they make more than the cost of equity. I'm assuming that over time, their return on equity, which is minus 13.7%, will make it to 9.44% over the next 10 years. And 9.44% is their cost of equity near term. So for the next 10 years, they're just clawing themselves out of the hole from a negative return on equity to a positive return on equity. That's only half the story. Deutsche has another problem. In addition to losing money, their regulatory capital has fallen way below what it needs to be. Their regulatory capital ratio is 12.41%. The median for banks is 15.67%. So I'm going to assume that over time they will have to try to claw back their tier 1, build up more tier 1 capital, and over time that their tier 1 capital will increase to. So two things are happening here. Negative return on equity is going to a positive return on equity, which makes their losses into profits. And as their tier 1 capital ratio increases, they have to invest huge amounts in regulatory capital, 6.55, 1.6, 1.6. So you can see the amounts invested. So that becomes my reinvestment. So take a look at the bottom line. My free cash flow equity for Deutsche is minus 11.6 billion. So this was done in October of last year. Minus 11.6 billion for the next 12 months. Minus 3 points. So if you add up the first 4 years, you're going to see negative cash flows. So at least in my valuation, I'm forecasting that they will have to raise fresh equity for the next 4 years. They did that first installment, 8.5 billion, a couple of months ago, but I'm sure there's more to come, because that's just going to bring them up to a reasonable ratio. To get to a safe ratio, they'll have to raise more equity. So the two big drivers of my cash flows here are net income going from a loss to a profit, and the regulatory capital going from a low ratio to the median for the banking sector. It was so much easier in 2007 because I could just take the dividend, just take the dividend, grow it, take the present value. And unfortunately, with all banks, I've moved away from dividends simply because I don't trust those dividends anymore. So the free cash flow equity and dividends here are very different, and they reflect two different points in time. Any questions? For Tata Motors, I estimated the free cash flow equity every year, starting with net income, okay, and CapEx. So basically, you have net income plus depreciation minus CapEx minus change in working capital. You can see that they did borrow a substantial amount of money during this period. So my free cash flow equity, right, basically reflects whatever's left over after my reinvestment. And it's the first year, of course, you have a loss, but you can see that my equity reinvestment is a pretty large number every year, almost 80% of my overall overall net income. Where is all this money being reinvested? Primarily in Jaguar Land Rover, not in Tata Motors domestically, because the growth and value seems to be coming from overseas. So already you can see a part of a story building for Tata Motors. This is an Indian mass market automobile company that's increasingly growing through its global arm, which is a luxury automaker selling in China and Europe and the rest of the world more than it does in India. But you can see over time the reinvestment reflects what they're putting back into the business. Which brings me to Disney. In the year ended September 2013, Disney's operating income was $10.03 billion. Their effective tax rate was 31%. Let me pause right there. The way effective tax rates are computed is based on taxes paid and taxable income, right? So if you look at so basically you go to the income statement, you look at the accrual income statement, it's taxes in that statement divided by taxable income. I'm taking the tax rate and applying it on my overall operating income. I actually don't pay that much in taxes, but I have to act like I do because the tax benefits of debt are already built into my cost of capital. So I should not be counting any tax savings I'm getting from interest expenses. So I'm basically applying that entire tax rate on that operating income. The capex was $5.239 billion, including acquisitions, and the depreciation was $2.19 billion. So they reinvested net about $3.6 billion during the year. Their working capital increased by $103 million, so that's another negative cash flow. So you start with $6.9 billion, which is their after-tax operating income, and subtract out the net capex and change in working capital. Their free cash flow to the firm is about $3.1 billion. That's the cash flow available to pay both lenders and equity investors. Dividends have to come from that, buybacks have to come from that, debt repayments have to come from that. So it's free only in a very, very loose sense, but that's the cash flow that I have available to pay my different claim holders. In fact, I'm going to create a ratio that, at least in the context of valuation, is a useful way of thinking about whether your company is reinvesting enough to grow. If I take the difference between my after-tax operating income and my free cash flow to the firm, it's about $3.73 billion that I reinvested back, the net capex and change in working capital. That $3.7 billion divided by the after-tax operating income gives me a reinvestment rate of about 54%. In 2013, Disney reinvested 54% of its after-tax operating income back into the business. Is that good or bad? What does it depend on? What you reinvested in. So you know the other half of this equation I have to give you is what kind of return did they make on that reinvestment? If it's a high number, this is good. If it's a number close to their cost of capital, you're just running in place. If it's a number lower than the cost of capital, this reinvestment is actually going to hurt them from the context of valuation because you're growing, but you're growing badly. So the free cash flow to the firm is the first stop in the process in figuring out what your cash flows will be in your discounted cash flow valuation. For some of you, when you do this for last year, you will get a negative free cash flow. Not because you were losing money, but because your company reinvested a lot last year. That's okay. There's nothing wrong with having negative cash flows last year or even next year or year out, because that high reinvestment is going to give you growth, and at some point in time, as your growth starts to ease up, your cash flows will turn positive. Okay? So first stop is cash flows. The cash flows can either be cash flows to equity or cash flows to the firm. In both cases, you're looking at cash flows after taxes. Let's talk about discount rates. Okay? We've already talked about cost of equity and cost of capital in the context of corporate finance. We've talked about cost of capital as being a hurdle rate when we talked about investment analysis. We talked about cost of capital as an optimizing device when we talked about capital structure. We talked about cost of capital as a divining rod when we talked about dividend policy. Should you pay more in dividends? Since we've used it in 3 different contexts, might as well bring in a 4th one. When you value a business, the discount rate you use will reflect everything we've talked about in corporate finance. If your cash flows are cash flows to equity, your discount rate will be a cost of equity. If your cash flows are cash flows to the firm, your discount rate will be a cost of capital. And guess what? We've already computed the cost of equity and capital for these companies. So in fact, those same costs of equity and capital that we've computed already in a different context are now going to become discount rates that I use in valuation. So let me start with Deutsche. In early 2008, when I did my Deutsche valuation, remember the dividend discount model where I assumed it was a mature, sensibly run bank? I used a risk-free rate of 4%, which is the euro risk-free rate then. I used a bottom-up beta of 1.16, based upon its mix of commercial banking and investment banking. And I used an equity risk premium of 4.5%. So in January 2008, the cost of equity I came up with for Deutsche was 9.23%. Different era, different time period. For that dividend discount model valuation, you're going to see a cost of equity of 9.23%. In October of 2016, the euro risk-free rate was close to 0%. It's 0.1%. Deutsche's cost of equity had risen to 10.2%. Even though the risk-free rate had dropped, their cost of equity had risen, partly because banks collectively had become so much riskier between 2007 and 2016 that it kind of made up the difference. So risk-free rates dropped between 2007 and 2016, But Deutsche's cost of equity has actually increased over that period because not only is it now in a riskier business than it used to be. Banking is a riskier business, but it's a risky company in a risky business pushing its cost of equity up. So two different eras, two different costs of equity. For Tata Motors in 2013, here's what my cost of equity looked like. And this actually I just cut and pasted from a previous slide that I used like 300 slides ago. I computed a cost of equity in rupee terms. So my risk-free rate is an Indian rupee risk-free rate, 6.57%. The beta is a bottom-up beta, 0.964, and it's a levered beta of the company. But because I'm discounting cash flows to equity, which include the interest income from cash, I reflected that in my beta calculation. It's 0.964. It's a weighted average of the beta of the equity and the beta of cash because I'm discounting cash flows to equity, which include the interest income from cash. You think as opposed to what? When I value Disney, you're not going to see me do this because there I'm going to value the operating assets and then add cash. Here I'm just going to do the valuation in one step. And because I'm doing it in one step, my beta reflects how much of my company is cash and how much is operating assets. The risk premium that I use reflects where Tata Motors does its business, where its revenues are coming from. Cost of equity in rupee terms is 13.5%. So I've got a cost of equity for Deutsche in 2007 and 2016, and I have a cost of equity for Tata Motors. Here's the last one, cost of capital for Disney. Okay? This is actually the fourth time I've shown you the same page, right? So basically it's the cost of capital for Disney in October of 2013 or November of 2013. Risk-free rate was a T-bond rate at that time, 2.75%. The beta that I used was just the beta for the operating assets. So when I do cost of capital, I ignore cash. I don't bring cash in because I'm focused just on the operating assets. Cost of equity of 8.52%. Risk premium is where Disney gets its business. For the cost of debt, I used Disney's actual rating, which was single A, got a cost of debt of 3.75%. Net of the marginal tax rate, I get an after-tax cost of debt of 2.4%. The weights are 88.6% equity, 11.4% debt. My cost of capital is 7.81%. When we did the optimal debt ratio, though, for Disney, didn't we conclude that the optimal debt ratio for Disney was 40%? The cost of capital is 7.16%. So why, when I'm valuing Disney, don't I use the optimal debt ratio and that cost of capital? Who's running Disney? I'll tell you who's not running Disney. I'm not running Disney. Bob Iger is running Disney. And what's he doing right now? He has 11.4% debt. This is actually an issue I have when I see discounted cash flow valuations in banks where people use target debt ratios to value companies. You know what that is? They would replace the existing debt ratio with the target. Okay, that's fine. But if it's not your company, don't go around replacing debt ratios with your targets, because if I replace Disney's existing debt ratio with a 40% debt ratio, I'm going to get a lower cost of capital, right? Hang in there with me. If I have a lower cost of capital, what's going to happen to my value for the company? It's going to be higher. Let's say it becomes higher than the stock price. I go buy shares in Disney. Why am I buying it? Because I think the company is cheap. But I think it's cheap. Why? Because I think it's going to go to a 40% debt ratio. So I buy the stock, and I open the paper the next day, and there's no announcement from Bob Iger that he's going to increase the debt ratio to 40%. So what's wrong with this guy? 2 days later, I look again, nothing's happening. 2 years later, it's still stuck at 11.4%. You see the problem? If you're a passive investor, don't go around replacing existing debt ratios with optimal debt ratios. Who can't replace it? So in what context should I replace the actual debt ratio with an optimal debt ratio? What has to be true about who I am as an investor? Potential acquirer or an activist investor. In fact, if you think about an activist investing in its truest sense, these are the kinds of companies where I will take a position as a Bill Ackman or a Carl Icahn, and even though I don't plan to acquire the company, I'm going to put pressure on the company to go out and borrow money. And if I'm successful, I might be able to push them to 40%. But unless you're an activist investor or an acquirer, you should be careful about replacing existing debt ratios with what you think is a target or an optimal. So that's why I'm going to start with the existing debt ratio, because that's what Disney is doing right now. Over time, though, I do agree that the debt ratio will probably drift up. Why? Because over time Disney has been willing to borrow money. And over time, here's what I'm going to assume, that the debt ratio, which right now is about 11.5%, will start drifting up towards 20. Not 40, because that's my optimal. But given how conservative they are, I think they will end up at 20. And this is a point I want to make about discounted cash flow valuations that I think you can think about when you think about valuing your company. All too often in discounted cash flow valuations, you will see people estimate a cost of capital up front and then use it through time as if nothing changes. That could work with some companies, but in most companies, you can expect the cost of capital to change over time. Why? Because debt ratios change, betas change, business mixes change, where you do your, what parts of the world you operate in change. In this case, the change is relatively small. My cost of capital for Disney, which starts at 7.81%, stays at 7.81% for the next 5 years. So I'm assuming they'll stay with the 11.5% debt ratio for the next 5 years. And after that, it starts to drift down. Not by a huge amount, but it does drift down to 7.29%. If you're valuing Tesla, give me a sense of what this number is going to look like up front in year one. Is it going to be a really high number or a really low number? It's a risky business. The cost of capital probably going to be 10, 11%. In your spreadsheet, assuming you're an optimist about Tesla, what are you doing to Tesla's revenues over time? You're making it small revenues into big revenues, probably 80, 90, $100 billion in revenues. That's what most analysts are projecting. And your spreadsheet, if you're an optimistic about Tesla, what are you doing to their losses? They're making the losses into profit. So by the time I look at year 10 of your spreadsheet, what's the story you're telling me about Tesla? It's going to be a mature company making a lot of money. Now I'm going to come back and say, in year one, I can see why you used a 10% cost of capital. It's a small money-losing company. Now in year 10, you're telling me it's a money-making mature company. Why is its cost of capital still 10%? Shouldn't it be 9 or 8? The median cost of capital for U.S. companies is about 8%. I'd be very surprised if you had a mature company with a cost of capital that's very different from that. So with growth companies, you'd expect to see cost of capital change much more over time over the period of evaluation, because on your spreadsheet, that's the story you're telling me about your company. So be open to the possibility that cost of capital can and should change over time for most companies. You're not giving it an unfair advantage. You're just reflecting the consistency with your assumptions about revenues and margins for the company. Yes?
Why does that ratio increases?
Does the beta? Because what's the average beta across all stocks? 1, right? You tell me you have a mature company, already you can see your beta. It's a levered beta. The average beta 1 is a levered beta. So it's not just the debt ratio that's changing. What else is changing about the company? The underlying business mix is changing. The unlevered beta is changing. It's almost like the whole game goes into motion. So the beta will change over time simply because it's a mature company. And mature companies will tend to have betas closer to 1 than further away from 1. So have no qualms about playing with today's, you're no longer talking about today's unlevered beta. When you get to year 6, year 7, year 8, you're talking about almost a different company at a different stage in the life cycle, and your beta should reflect that. Okay. Any other questions? So many of you have companies which have no debt today. In fact, yesterday I got at least a couple of emails saying, should I change companies because I have no debt? Same answer I gave you with no dividends. It's okay. A lot of companies have no debt, and today if your company has no debt, it's not a big deal. Your cost of capital is your cost of equity. But when you do valuation, here's the question you still have to answer. Will your company remain debt-free forever? You could say yes and say, I'm going to give it just the cost of equity. Most companies, though, as they mature, at some point in time will start to borrow money. So in your cost of capital, you might say, I'm going to start at 11% cost of capital, which is equal to my cost of equity, but by the time I get to year 10 and I make my company a mature company, I'm going to give it a cost of capital closer to that of a mature company, which might reflect the use of some debt, because that's what mature companies do. Right? So we talked about cash flows, we talked about discount rates. Let's at least set up growth. How many of you have worked in valuation before in your previous lives? Don't worry, I'm not going to ask you questions, specific questions, put you on the spot. Worked in valuation. When you value a company, you need a growth rate, right? You can't do valuations without growth rate. So I'm going to ask you a question about where you got your growth rate in your valuations. Where do you get your growth rate? One is you look at historical data. That's a normal place to go, right? What else? You ask managers what the growth rate will be. We're getting there. What else? You make up stuff as you go along. You're managing director. But my point is, I call these you see why they're exogenous? They come from outside. Even a historical growth is from outside, right? And that then drives your valuation. Remember we talked about valuations being stories? When your biggest number in your valuation comes from management, in what sense is this your valuation? Because you've turned over the biggest part of your story to somebody else. That's management's valuation given their growth rate. So the first thing I'm going to argue about growth is take ownership of it. This is your company. Don't assume that just because equity research analysts have tracked this company for 20 years, that they somehow have insight about growth that you don't have. This is your number, and you need to think about what drives it. So I'm going to give you the drivers of growth, and these are called intrinsic drivers, and take them for whatever it's worth. Growth is not magical. I can't go around endowing companies with high growth just because I like you as a company. For a company to grow fast and grow well, it's got to pull off a pretty tough trick. It's got to reinvest a lot, right? Over the short term, you might be able to grow without reinvesting, but over time, if you want to grow, you have to reinvest a lot. In whatever business you're in, if you're a manufacturing company, you have to build more plants. If you're a technology company, you have to do more R&D. If you're a services company, you might have to acquire other companies. You have to reinvest a lot. That's an easy half of the equation. And while you're reinvesting a lot, you also have to reinvest well. You see, what does that mean? Well, if you want to think in terms of numbers, I'm looking at what kind of return you make on the investments you make. Do you make a 12% return or a 2% return? And we measure how much you reinvest with what percentage of your earnings you put back into the business. So let's go back to the equity versus firm, and you can see how these numbers will play out. If I'm trying to estimate growth in equity earnings and ask you how much do you reinvest, you're going to look at the percentage of net income that you put back into the business, right? And in fact, if you think about the payout ratio is what you pay out. Whatever you don't pay out, it's called the retention ratio becomes what. So if you have a payout ratio of 20%, you're reinvesting 80% back into the business. So with equity, the retention ratio becomes a percentage of net income that you put back into the business. So that's how much you reinvest. When I ask you how well do you reinvest, remember you think like equity investors. The way you measure returns is you look at returns on equity. Why? Because that's all you care about. Net income divided by whatever equity investment you have. So with equity growth rate, it's retention ratio times return on equity that drives growth in equity earnings. Yes? It's a problem, right? I mean, it's in a sense, because here again we have to separate. When we talk about return on equity, what are we talking about? Not return on equity in past projects, but return on equity in future projects. You know what the problem with negative book equity is? It takes away that data item that we usually draw on. It's nice to have last year's return on equity, because then we can make this leap of faith of last year your return on equity was 25%. Your new projects have a return on equity of 25% as well. If you have negative book equity, that last year's item becomes not meaningful. But you still have a task of estimating next year's return on equity without that historical data. What are some of the alternatives that you can use? If you can't use this company from last year, what are the potential ways you could try to come up with return on equity still? Or you can look at history, right? So basically, one of the reasons return on equity turns negative for many US companies is not because they have a bad year, but because they do a big buyback, and when you do a big buyback, your equity goes negative. One of the ways you can try to fix that is add the amount that you bought back and look at what your return on equity would have been without the buyback. It's cheating, but at least it gives you a number. Or you can look at the history, look at the last 5 years, last 10 years, maybe you can come up with a return on equity. But let's say none of that works. Where else could you go to get a return on equity for your projects? You could look at industry averages. One of the reasons I attach those industry averages to all of my valuation spreadsheets, there are times when I look at the history. I'll give you a very simple example. Return on invested capital for Apple is negative. Strange, right? One of the most profitable companies in the world. You know why it's negative? What's the definition of invested capital? It's book debt plus book equity minus cash. There's your answer. This morning's Wall Street Journal, if you look at the cash balance for Apple, I think the earnings report comes out this evening, it's $250 billion. You subtract that from book equity, their invested capital actually becomes negative. What does it mean? Not that Apple takes terrible projects, but that last year's return on capital for Apple is close to meaningless. But I still have a task when I project growth as what the future return on capital is. There, at least with Apple, I have a history that I can draw on. And if you look at the history, it's like a 35% return on capital if you get past those negative numbers in recent years. But you got desperation will drive you to places you don't want to go, but feel no shame about it. The reality is, you got to come up with an estimate. Your estimate is as good as any other. Base it on something reasonable. What does the rest of the sector do? So when you think about growth in equity income, you do need at least a measure of what that return on equity will be for the future. Yes?
Question on the retention rate and the reinvestment rate.
Right.
What if they retain the money, but they just put it in cash?
Then it's a problem. In fact, that's a good question. What if you remember I said anything you don't pay out as dividends is a retention ratio? The question is, what if you just retain the cash and hold it, retain the earnings but hold it as cash? Where is it going to show up? What's the return on equity in cash? It's going to be a really low number. So you're going to have a high retention ratio then, but your return on equity is going to be 1 or 2%. So you're not going to get a benefit of high growth just because you retain money. You need to retain the money and actually take projects that are on a high return on equity. Then the retention rate. Depends on the, yeah, that's mostly true.
When you ask for the cost of the firm at zero debt, won't it be unlevered value minus the expected bankruptcy cost at zero debt? Which would be what? So you basically, how do you know what the rating will go to? You can't take the existing rating, then there will be no bankruptcy. There's no marginal bankruptcy cost of borrowing. If you keep the expected bankruptcy cost, say with zero debt and the existing debt, now you can borrow money. No, but given you're saying that if your debt ratio is pretty much zero, we might as well keep a AAA rating, and we have the expected bankruptcy cost.
Oh, is that what you did? You AAA rating?
Yeah, so essentially what I did was calculated the essential equity plus debt, followed by subtract the debt part. You had given the bankruptcy. I mean, I just wanted to confirm. And one last here, shouldn't it be plus? It will essentially be minus the debt that you repay and plus the debt that you issue, the new debt that you acquire, right?
Right. Is it signed off?
Yeah, because shouldn't it be plus here or these two kind of replace?
That should be a plus. Thank you very much.
I had a question about my company on the screen. I'm doing Turkish Airlines, and there's a breakdown of the financial statements from the individual flights to different geographies. Do flights to different countries kind of operate in those countries? Because a customer can like buy a ticket in countries.
Probably not. It's probably primarily.
So actually,
Overview about eBay's tax rate and effective tax rate. Just in general, I mean, they've been.
Don't compute taxes based on operating income ever, right? Because
Okay.
it's taxable income. Interest income
Right.
should be part of there. So,
Right.
So you want to leave it at 20. The 26.5% was it their computation?
That was mine, but that was basically adding the interest benefit back in, not taking out their interest expense. So they I'll show you their.
I'm confused. So what did you use?
We divided basically
So you have taxes paid in the numerator.
taxes paid in the numerator, but they still kept the interest. Like their net is in their 10K they have a net interest benefit. So basically, they have their operating income, and then they add interest back in because they've made interest on some of their
Yeah, which you
investments.
should, right? Because
That's
it's
okay.
part of your taxable income. So
Okay.
you shouldn't be cleaning it up for that. Because
Okay.
that's perfectly okay. That's part of your taxable
Okay,
income.
gotcha.
So you should have interest income from cash minus interest expenses to get
Okay,
your tax.
so it's okay to have because I guess I was just confused
But-
because with taxes,
Yeah.
like they have this higher.
That's got
basically-
something to do with something else. So basically,
Yeah, it's a
when they
weird
have-
tax
there's
thing,
something
so-
that happened that year that was
Right.
nothing to do with interest expenses, some
Right.
outside item. So basically, you want to
Yeah.
take that outside item out, but
Right.
don't do anything with the interest.
So going forward with some of the free cash flow projections, should I still use basically this.
The free cash flow to the firm, free cash flow to equity, free cash flow.
I guess both going forward.
Free cash flow to the firm is a pre-debt cash flow, right? So you're going to go with operating income
Okay,
and using the effective tax rate.
Okay.
Free cash flow to equity starts with net income.
With net
And your problem is going to be your net income for 2000. So start with